What if you could get all the money back for every purchase you ever made, and you could build wealth through the debts and expenses you already have? That's all covered in Mapping Out the Millionaire Mystery. But today, what we're going to do is we're going to break down how I've used the infinite banking concept. We're going to break down how you can use it all the way, start to finish. Simple as paying off your debts and building wealth doing that. Also, saving your business, just like I had to. Taking over payments from copy machines that you used to pay to somebody else that you take back and pay to yourself. These are the things that we're going to cover today and a lot more. Let's dive in. Welcome everybody, another week, another wealth webinar. Thanks for joining us today. We're going to get right into it. We're going to get into the infinite banking concepts. And this is going to be a really amazing training. And I'm not just saying that. I mean, we do this every week. We've been doing this every week for, I think 7 years now. So I'm very honored that all of you are here. But today we're going to get into infinite banking. But I'm going to start with where I learned this. I was a financial advisor. And then I heard about this from a wealthy individual, and he kind of explained it. And I was, at first, probably like a lot of you, I was kind of standoffish. I was like, I don't know about that. Because I thought I knew what I didn't know. Will Rogers says it best. He said the biggest problem in America isn't what people know. It's what they think that they know that just ain't so. The biggest problem is not what we don't know. It's what we think we know that just ain't so. And that was me. I was the advisor. So I thought I knew everything there was to know about financial markets and different things. And I thought I'd heard it all. And then this guy, who had a lot more money than me, tells me about this thing called the infinite banking concepts. He called it privatized banking. And I'm like, nope, no, that just sounds too good to be true. But you know what? I was willing to kind of listen, and I was willing to learn. So that's what I did. And that's what a lot of you are doing. Even though this is your first time, I promise we're going to go right back to the fundamentals. We're going to go back to the beginning. I'm going to teach you what the infinite banking concept is. We're going to get into that in just a second. And then we're going to walk through different stages, different layering techniques of the infinite banking concept, so that no matter where you're at financially, you're going to see where the fit could be for you. And then after that, the next step is we just jump on a call. And I'm not like a lot of the other companies out there that thinks that AI is going to be the end all be all. I think AI is a really important thing, but you will never, ever, ever speak to AI in my companies, period. You always speak to a human being, because a human being has empathy. A human being has love. A human being truly, in their heart of hearts, wants to help other human beings. That's just how we're wired. Some are better than others at this. My team is exceptional at this, and we want to solve your problems. So when we get into this, you're going to learn today. Some of you, this will not be your first time learning, and it will not be your last. It's always about learning. I'm still learning, but eventually you got to look at your situation. I was talking to somebody earlier. They were thinking they were a little bit too old in the chat, and they were like, I think I'm going to do this for my children. And, Bruce Lee said that best. He said, why not? Bruce Lee said, instead of buying our kids all the things we didn't have, why don't we teach our kids all the things we never learned? And that's what you're talking about doing, is teaching your kids the things you never learned. Listen, I learned this I think it was in my 30s, if I'm not mistaken. Some of you are in your 60s. Some of you are in your 20s. Doesn't matter where you're at. You're in the right place at the right time, because that's how it happens, right? Everything you learn, and when you learn it, is at exactly the right time. And that is what we're going to talk about today. You can see people show up, they join the campfire, they get around, they're like, I don't know about this infinite banking thing, and that Craig guy and that Chris guy, I just don't know. But you know what? They come back. So here's what I want to do, is I want to jump right in. When I first learned about this, it was foreign. It was brand new. It was something that was outside my comfort zone. It was something I didn't fully understand, but I kind of understood pieces of it. And then what I did is I learned all the pieces. I learned, most importantly, the process. So we're going to talk about what is the infinite banking concept. And I'm going to start by walking you through the bare bone essentials, the fundamentals of the infinite banking concept. And it starts here with this little thing. The infinite banking concept is a process. Let me be clear. It is not a product. It is a process. Now, we're going to talk about a product today. That product does one thing and one thing only: provides efficiency. Okay? That is the only reason we use a product. You today use a product, whether you think of it as a product or not. It's called a bank account, checking account. maybe a savings account, maybe a money market, but you use a product to run your money through. Your product that you were taught to use does not serve you. It serves the institution. The institution wins 100% of the time there. I'm not going to go into the nuts and bolts of that, but that's how it's designed. What we're going to do, we're going to change the product. We're going to change the place you run your money through. We're going to get out of the banking side and we're going to get into the giant insurance industry, okay? Because they are more financially stable and because they are more aligned with what you want. And what you want is you want to control your money, whether you think it or not. That's what you want. You want to be in control of your money. And you also want to take back the banking functions in your life. You no longer want to pay interest to the banks. You no longer want the banks to make a spread on your money. You want to be paid interest on your money. You want to be the one in control of your money, and you want to be the one making the spread, not the banks. Well, to do that, we have to change the product we run our money through. And it looks a little bit like this. We want control of our money. We want certainty of our money, which is also guarantees on our money. We want liquidity of our money. Now, how many of you want liquidity on your money? I think right now that's a really important thing. There's a lot of crap going on in the world. There's going to be a lot of opportunities in the coming months, coming years. You will need liquidity. So if any of you want liquidity, put liquid in the chat because that's going to be one of the most important things. And to have liquidity, you must control your money. And also efficiency. So to do all of that, we got to start where all of us are, okay? Every one of us are in a different place. Some of you are multimillionaires. Some of you are probably 100 millionaires. We have people that join us on this show that run massive companies, massive enterprises. And then we have people that join us on this show that are just getting by, that have just enough. It doesn't matter what side of the spectrum you're on. This process, again, I want to repeat, the infinite banking concept is a process will help all of you. There are people it won't help, but usually it's a mindset problem, not a financial problem. So we're going to start with where you're at financially, and that's going to start with your income, okay? This is money, and all of us make this. Some way or another, we trade our time for money, and then we do something with this. We take this, the money we earned, the money we traded our time for, and we take it and we put it into an account. We put it in a product. Today, that product has one of two functions where we put it. You're going to put it in a bank account. Some of it is going to be spent. It's going to be spent on diapers. It's going to be spent on groceries. It's going to be spent on rent and mortgage payments and all the things you need to do to live. That's fine. That particular product called a checking account is the good, perfect instrument to pay your traditional bills, your living expenses. But you have to understand, those things, that means you spend the money on it and that your money's gone forever. But that's okay because we have to, that's the only way we get by. That's how we survive. But then I would guess most of you take some of your income, okay? Some of it goes to the bills. Some of it you save. You save in various different places. Your savings could be called a 401k. It could just be called a savings account, okay? It could be called a money market, a brokerage account. Doesn't matter what your mechanism is for saving, you are putting money into a savings account for some particular reason. Could be retirement, could be an emergency fund, could be saving up for something. That, your savings, is what we need to change. We are going to change one thing, and that is where your savings goes first. We're going to take it from this rhino and give it to this rhino, and that's it. I'm just kidding. I just had to draw some pictures here. And that money that we use, okay, is used for saving to buy something. And I'm just drawing a car here. But now let me show you why we're going to change where that money goes first. This is where we get into the question of, well, why would I change where my money goes first? Well, let's go into the things that I have identified by talking to thousands of people as the reasons why. Number one, guarantees. You want guaranteed interest. Whether you think it or not, you want guaranteed interest, okay? Okay, the whys, you want guaranteed interest. And you don't want that interest rate to change. So what if we could find a place where we could put our savings that has a guaranteed interest rate that never, ever, ever changes? Doesn't change if the Fed drops rates, doesn't change if the economy goes into a slump, doesn't change. It's just contractually guaranteed to remain the same for the rest of your life. And what if we just put a number on that guaranteed interest of anywhere between 2 and 3.25%. Would that be okay? That's your lock, stock, and barrel guaranteed interest for the rest of your life. Now, I know your bank account, your savings account might have an interest rate. As a matter of fact, how much is everybody getting on their high yield savings accounts? Put the percentage in the chat. I always like to kind of see what everybody's getting, see if there's some crazy bank account out there. So that's about right. That's right in line with where the Fed rates are. And that makes sense because banks are going to pay you an interest rate based on what they can make. So if the banks can go out and get 4% in a 6-month or 1-year T-bill, okay, which is a treasury bill, issued through the treasury, then they're going to give you whatever, 3%. They're going to make the spread. Now, Scott's getting 4.1, so he might have like a longer duration one where they're going out and buying longer duration treasuries, or they're just giving a little bit more interest. But here's the thing on all of those interest rates, whether it's Scott's 4.1, Alicia's 3%, that interest rate is not guaranteed to stay that amount. It will fluctuate. If tomorrow Jerome Powell or whoever the Fed chair is comes on and drops interest rates, Scott, I'm sorry to tell you, but your 4.1 will be lower. Same thing, Alicia, your 3% will be lower. We already know that to be fact, but right now we're taking it while we can get it. But here in this account, your guaranteed interest rate, whether it's 2, 3, or 3.5 or 3.25, whatever it is with the product we put it in, that's locked for the rest of your life. But here's another thing. Every single year, this is not guaranteed. So this is kind of like Scott's 4.1. That's not guaranteed. You're going to get a dividend in this new account. Now, they have never, ever, ever not paid a dividend. Not in all the years they've been around, and all these companies have been around for 140 to 160 plus years. They've never missed one. Not through the Great Depression, not through the Great Recession. They're not going to miss one through the next recession either. They always pay a dividend. So if we take the guaranteed interest plus the dividend, we're going to call that the dividend crediting rate you're going to earn today, which is, I almost just said March, but it is April Fool's Day. April Fool's, which is April 1st, 2026. The companies we work with are paying 5.9 to 6.6%. And that is not an April Fool's joke. That is what they're paying in dividend crediting rate. But you know what? It's even better because the guaranteed interest plus the dividends you earn, the growth that you're going to earn on your money is going to grow tax-free because we're going to design it for you that way. We're going to make sure that we design it within the parameters of the IRS so that it is tax-free growth. So if you made 5.9% on your money, that's 5.9% tax-free. That's pretty darn good. In your bank account, you'd probably have to earn 7%. Whatever the after-tax yield, effective yield would be, you'd have to earn way more because you'd have to pay tax on it. So we're already doing better than we are with the place where your money is, but the money's protected. It's also private. So if you get sued, your money, depending on the state you live in, is protected from judgments and liens in most states. Not only that, you're in full control. It is incredibly efficient, which we're going to get into. And it's got certainty. Certainty because there is very few moving parts. The only moving part really is that dividend because that can fluctuate and change, but it doesn't change much. There's no volatility in this. It's not like your stock account or your 401k. There's no restrictions, okay? And when you die, a death benefit will be paid tax-free to your beneficiary, and that means this account that provides higher returns, dividends, and a tax-free account protected from judgments and liens in a private environment that is controlled, efficient, certain, has no volatility, and provides a death benefit, so it is self-completing. So anyway, unless anyone on here can argue that that doesn't sound better than where your money's sitting today, which is probably a bank account, a high-yield savings, maybe a money market, well, then I think we've made a pretty good argument as to why we would change one thing, and that is where your money goes. And what is this one change? Where is your money going to go? Well, it's going to go from the banking industry or the Wall Street industry into the insurance industry, the life insurance industry, the same place that the Rockefellers, the Rothschilds, the Morgans, the Stanleys, Ray Kroc, Walt Disney, McCain, I could keep going on, but all those names that you're familiar with, why they changed, where their wealth went, and why they decided that the insurance industry was a safer bet than the banking or financial industry. That is it. So that product, okay, because now we're only going to talk about the product, happens to be something you're familiar with. It is a whole life insurance policy, but not any whole life. It is a specially designed, let me preface that, specially designed and engineered whole life insurance policy from a mutually owned life insurance company that pays dividends. That's it. You don't have to like that. Because when I heard what that place was, after I was told all those cool things, I'm like, nope, don't want one of those. Heard those are terrible. Heard those are just big commissions. Yeah, well, you forgot that I said specially designed and engineered. See, in order for us to build your policy, to do all those things and to have immediate high cash value, meaning your money that you have in it can be accessed immediately in the first 30 days after your deposit, or even sooner if your check clears faster. In order to do that, we, as the agents, as the constructors of that specially designed whole life, have to take a massive cut in our commission, which is how we're paid. You don't have to pay us anything. You'll never write us a check. We get paid from the insurance company, but our pay from the insurance company, called the commission, is reduced between 60 and as much as 90% from a regular whole life. That is because we design it for you to have immediate high cash value. But now that we understand the whole life product, now we're going to talk about the flow. We're going to talk about the process, which is really the single most important part about today. And we're going to get into this quick. When we need money from this account, we are going to go in online or pick the phone up, either way, whatever way you want to do it. You're going to request a loan. You're not going to take withdrawals like you do your bank account. We're going to take loans because the insurance company has a really cool provision. And this is all whole life policies, but these are what we're going to call non-direct participating whole life policies. Not going to get into that, but just hear me out. We're going to take a loan. And the insurance company is going to ask us a couple questions like, where do you want the money to go? How much do you want? Is this part of divorce decree? And that's it. And then how much do you want? And you're going to tell them. And then that money is going to show up in your bank account within 36 hours. Might be less, might be a day more, but it's about 36 hours. And here's why we're going to take a loan, because a lot of you don't like that word loan. But here's why you want to take a loan. Remember I said your policy is going to pay 5.9 to 6.6% dividend crediting rate. Now, that's not what you're going to actually make because there are costs, cost of insurance, commissions, policy service fees. But we're going to show you what you're going to net in a little bit, and it's very good. But we're going to take a loan because the insurance company has agreed that they will allow us to use their money. That's true. Just kind of like, think of it like a home equity line of credit. You've got a house that has equity. You get a home equity line of credit. The bank allows you to use the money in your walls, your equity. You can use that money in the form of a home equity line. They charge you an interest rate, but you get to use the money. So if your house continues to grow, your equity goes up. It's kind of the same idea. Your cash value does not get affected. It continues to grow with that guaranteed interest and that dividend uninterrupted while you get to use the money at the same time. But the interest rate that the insurance companies charge, we have one that charges under 5. We got one that's up in the 6% range and coming down. But basically, if we just kind of blended it, about 5% is about 5 to 5.3% is what you can borrow the money at. So let's just say your money was earning, I don't know, let's just say 5.5. I'm just going to pick a number, and you could borrow it at 5. You're making 5.5, and you could borrow it at 5. How many of you would borrow money at 5 if you could make 5.5 on it with no risk? You would. All of you would. You'd be silly not to, because you'd make 0.5% for doing nothing. It's called an arbitrage or a spread. This is how, just so you all know, this is exactly how banks make money every day. They pay you 3, or we'll use the 4.1%. They pay you 4.1. They go out and they make 6% on your money. And they do it with very little risk. Okay, so they make 6, you make 4, right? They're making a 2-point spread. We're just reversing the role because we're becoming the bank. We're taking control of our money and we're using an efficient vehicle to do that. So now we make the spread. So of course you would take the loan instead of a withdrawal because your money continues to earn. So now we've got the money. Then what we've got to do with that money is we've got to find somewhere for that money to go. And that's what today is going to be all about. It's going to be talking about different layerings, different stages of infinite banking. These opportunities can be everything from financing and lending. It could be things like paying debt off, business loans for your company, which I've definitely used it for that. You could use it to make investments, to buy real estate. It's really infinite. But let me just kind of give you a quick walkthrough on how this works, because it is quite simple. Let's just say you had $10,000 in your whole life policy. And over here on this side, you had debts. You had credit card debts. Now let's just say you had debts of $9,000, okay? In those $9,000 debts, you were paying $500 a month, trying to pay them off every month. And the credit card company was charging you 20%, just keeping this super simple. You don't need to see the board if you can't. You got $9,000 in credit card debt, $500 a month is what you're paying, and 20% is the interest rate that the credit card is charging you. Okay, this is your scenario, hypothetically. So what we're going to do is we're going to take a loan for 9,000. Actually, can we round this up? I'm going to keep this simple. 10,000 bucks you owe. We're going to take a loan for $10,000. Fair enough? We're going to then take that 10,000, we're going to pay off this debt, which means you no longer owe the credit card $10,000. You no longer have to pay them $500 a month. But now what we're going to do, folks, is we're going to take that $500 a month that you used to pay to the credit card, because that was your monthly payment trying to pay that $10,000 off. But you paid the $10,000 off with a loan from your banking system, which is your whole life. The $500, normally, for all of you, if you paid a credit card off, would just sit in the bank account because you don't have the bill anymore, so that $500 sits there. And a lot of you, or your significant other, would spend that $500. So we don't want to just leave it there. And we also don't want to let the bank use our money anymore. So we're going to take that $500 that's in this bank account, which is the center, and we're going to recycle and recapture it back over here to the policy. We're going to put it back into the policy. Now, this is not a premium deposit. Okay, what this is a loan repayment. You are literally telling the insurance company that you're repaying $500 of the loan. Now, here's the cool part. When you do this, $500 appears in your account the next day when your check clears. So you have $500 to use, dollar for dollar. You put $500 in as a loan repayment, you have $500 the next day. Because the insurance company only calculates the interest or only charges the interest one time per year. Fair enough? So, but here's really how it works. Over the course of 1 year, and I want to do some quick math for you because this is really fun. Over the course of 1 year, you would have paid $6,000 back into the policy, which means your policy now has $6,000 more that you could use anytime you wanted it. But you have now paid $6,000 of the $10,000 loan. Remember, the insurance company was charging you 5% on the $10,000 because that loan that you took from the insurance company, they gave you that loan and they charged you 5% interest, hypothetically. But the loan they gave you was effectively them giving you part of your death benefit while you're living. They just advanced you $10,000 of your death benefit. Now, there is a downside to that because if you died the next day after you took the loan, your family, your beneficiary would get $10,000 less in the death benefit. Just understand that. This isn't free money. This isn't hocus pocus. It's not smoke and mirrors. The 10 grand came from the insurance company's general account. They loaned it to you, and that was a loan of your death benefit while you're living. That's all you need to understand. And you can take loans up to the max amount that you have in cash value, just so you understand the rules. But now you repaid $6,000, $500 a month. You repaid 6 grand. So that's $4,000 left after the first 12 months. Your cash flow as a family hasn't changed at all. The $500, it was like saving an extra $500. It's nothing different. You used to give it to the credit card company. Now you're keeping it dollar for dollar. The 10,000 bucks that you initially had in the account is still in the account earning interest and dividends. Okay. The insurance company, yes, they were charging you interest. So that would have been $500 the first year, 5% on $10,000. The $500 would be the interest that they would have charged in the first year, but that won't be your interest because every month you were repaying $500 of that loan. So after the first year, and I'm just doing simple math, you didn't pay $500 anymore because now you only owe 5% on $6,000, which is the same as paying 2% APR. So now it's $200 a month, or sorry, $200 that year in interest, the year 2. And then after that, it's all paid off pretty much. But you kind of get the gist. So what you were able to do is you were able to use the system called the infinite banking concept to increase your spread. Because remember, first we started with a scenario where you're making 5.5 on the policy and you were paying 5. And I said you'd all borrow at 5% if you could make 5.5. Did you not? I think everybody did. Craig, did everybody say they would borrow? Most people would, because you make 0.5% for doing nothing. You make the arbitrage. But now, after 1 year, doing exactly the same thing, not changing your cash flow, not saving any more money, doing the exact same thing, just changing how you did it, what you've now been able to do is increase your spread. There are 2 things that increased your spread. Number one, over 1 year, your 10,000 compounded at whatever the dividend crediting rate was, whatever your net earning was, okay, which we hypothetically said was 5.5%. I'm just making numbers up. But you were compounding, so you're now earning on a higher amount. So you're making more money. Really what happened is you paid down the loan. You bought down the APR. This is just how math works. So in that scenario, if you in year 2 effectively paid 2% APR compared to what you were the first year, 2 minus 5.5, yeah, your spread just went up, didn't it? Yep. See, banks do this all the time to you. All you're doing is learning their game, applying their game. You're just doing the same thing the bank does. And we just do this over and over. We just keep repeating this cycle over and over. When we're done with our debts, we start lending or doing financing. We start doing it for business, investments, real estate, all these different things. Let me show you something, because I think this is a really good way to show this. You all understand how your house works. If you own a house, you probably have equity in your house right now, represented by this little drawing or this little picture here, okay? Let's go to the next slide. Let's just assume, I'm just going to make some assumptions here, that you had equity in your house of $150,000. You went out and got yourself a home equity line of credit, okay? This is just, I'm just making an example so you can parlay the difference between this and the policy. If you borrowed $100,000 and the bank charged you 5% on your HELOC, your monthly payment would be $417. Now, this is assuming you had a monthly payment, because you would if you had a HELOC. If you took a loan from your policy, you don't have a monthly payment to the policy. You're going to recapture money, but you're not required to. With the HELOC, you're required to. $417. If you took that money and you lent that $100,000 out on Private Money Club, you lent it on a first lien position real estate deal, hypothetically, and they paid you 12%, you'd make $1,000. Okay. People get excited about this all day long, because in this scenario, you made 1,000, you paid 417. 417 was the cost of using the equity in your house. 5% on 100,000, 417 a month. But you made $583 a month. For some people, when they do this, they're like, oh my God, I just printed money. Because you kind of did. You made a spread. You took money at one rate, you lent it out at a higher rate. It was money you didn't have before because it was buried in the walls of your house. And then what you did is you made a spread. You made $6,996. Everybody understands that. But you see, what if you did this exact same thing, but you did it and you replaced HELOC with policy? We literally just take this thing right here, we cross off HELOC, and we do whole life. Okay, this is your whole life. Because the numbers would be about the same. If the insurance company charged you 5 and you borrowed $100,000 because you had $100,000 in cash value, this would be the same math, except you wouldn't have only made $583. Okay, that would have been the spread on the interest rate, but you would have still made the interest on $100,000. So whatever that was, if it was 5%, that's 5,000. So whatever that would be, you get it, right? So now you made more than 583. You made 583 plus 417. If you made 5% interest on your policy, that is. I'm just trying to help you understand this in a very simple way. So now that we've gone through that, I want to start to expand your thinking a little bit. Okay. So now we're going to get through that. Craig, any questions before I move on to the next part?
Joe had a good question. I don't know if we want to address this now or a little bit later, but he was asking about when you're doing the arbitrage, doesn't it make sense? And this is more of an opportunity case where, say, you take the money out, you put it into an opportunity, just like you showed, making 12% in private lending. Would you want to just pay the interest back, or would you want to pay it all back? And so there's a lot of different ways we can run that money. So he's just asking.
But here's the beauty. It's an easy one to answer, Joe. The easiest part is it depends. It's up to you. Thou with the gold makes the rules. When you are your own bank, you make the rules. When you do that from the HELOC, you didn't make the rules. The bank first sets the rules, then you comply with the rules and add on to it with the policy, because the insurance company doesn't care if you ever pay the loan back. I mean, you should always pay the loan back, but they don't care if you do, because it was just an advance of your death benefit. And they would be happy if you never paid the loan back, because they'd make interest on that money until the day you died, and then they'd true up at the day of death. See, that's the beauty. So in the middle of that, you can decide whatever you want to do. So if you were arbitraging, would you pay it off? It depends. We'd run the math. We have software called the Vault, which we'll show you in a little bit, that would run the math. And then you could decide, does it economically make more sense to pay the loan off or down, or just keep the money out and keep arbitraging? In some scenarios where you have the money out there working, we'll show you the gains projector in a little bit, then it might make sense to just keep the money out there, keep it working, keep going deeper and deeper. But again, it's really up to you. Or what some people will do, Joe, is take part of that arbitrage and just plow the money into the paid up additions rider, which absolutely makes sense if and only if the PUA has the capacity within the way it's built. So I don't want to get too deep into that, but we'd have to build the policy to hold that extra money, and that can be a slippery slope because if you're designing something for future that you don't know what it is, for a future you don't know what it is, you can make some mistakes and cost you some efficiency, and that's not something we like to do. So that's a great question, Joe, and I think we can get into that when we show you the gains projector. But again, I want to stay on track here, and I want to keep kind of expanding on that original idea of what we said, right? We want to create our own banking system. We don't want to conform to what the banking industry has told us to do. Deposit money in the bank, you put money into your 401k. When you want a car, you borrow money from the financial institution and then pay them principal and interest. We want to create our own banking system. And if we can do that, how the infinite banking helps you is it puts you in control, allows you to recycle and recapture all the interest, the money you're leaving, that's leaving your family. You get to recapture all of that, and you get to take back the banking functions. That's probably the most fun part. And it looks like this. Here's you put your savings into the policy, you take loans from the policy, put them into opportunities, and recycle and recapture. So Joe, when you're thinking about what you just said, this is just the general flow. But it doesn't matter what the dollars and cents are of how we flow that money. Does it all just go back to the loan, or do we put half of it back to the loan and do we do the other half into the paid up addition? It depends. It's whatever you want to do, but this is the general flow. New dollars come into the policy every year, every month, however you want to fund it, however you're saving today. And I want to be clear because a lot of people get this confused. The premium deposits are the same dollars that you're saving today. So if you're saving 10% in your 401k, but yet they only match 5%, we might back down the 401k contributions to 5%, never less than what your match is. So now you're putting 5% in the 401k. We take the other 5 you used to put in the 401k because you're used to saving that, and we redirect that over here to the policy. Maybe it's a bank account that you're doing that with instead of a 401k. We're just going to redirect that savings. Maybe it's a Christmas fund. We're going to redirect that Christmas fund, that vacation fund, that college savings fund. You follow what I'm saying? That's the premium deposits. That's this dollar right here. That's new money every year, every month, saving going into the policy. We're then going to take that money and we're going to use it. You're already doing this today, except for you're using the bank's money. We're going to use that money for an opportunity. Debt. We could use it for business uses. We could use it for lending, real estate, investing, all those things. But the most important part is this is the biggest mistake people make. This is the biggest reason we created the Vault software, the GPS, is so people don't miss this critical step. They do the opportunity, pay off their debt, lend their money out, and then they take the interest or whatever it is that they paid on their debts and they just leave it in the bank account. It's almost like sometimes I feel like I'm just talking at a wall. And this isn't for all of you, but this is a lot of people that we've helped. They don't recycle and recapture the money. And when I ask them, they're like, well, I don't know. I didn't know I had to. That's a legitimate thing. You technically don't, but why would you leave your money in the bank? Why would you just let them use your money when if you just changed it, recycled and recaptured it back over here to the policy, you make more money and you took no more risk. You didn't work any harder, any longer, and you took no risk to make more money. It's just an extra step, but we do all that for you. So I want to be clear, like when you start a policy with us, and you learn to implement the IBC policy or the IBC process with us, we do a lot of this for you. You have options on how you work with us. So we don't just kind of pat you on the ass and send you off, in the wild blue and say, all right, good luck. Call us if you need us. That's not us. That's all the other IBC shops. No disrespect to any of them, but that ain't us. We're here to fulfill. We're here to walk you down the path. And listen, I think I said this earlier, but you'll never talk to AI with us. AI will be part of everything we do for efficiency. You'll never talk to AI. For example, maybe someone on here, maybe Joe is like, shoot, man, I need to talk to somebody right now. I need to get on the phone right now because I got this idea. I want to see if this would work. Just like Joe. Joe's like, hey, what if I did this, and what if I took an extra and I put it into PUA and I put the rest into loan repayment? How would that look? Great. We can model that. So if any of you, during the course of any of this webinar or after, want to talk to a human being who cares, who wants to solve your problem, who will walk this walk with you. They are available. All you do is you give us your number and your email. That's all we need. Your phone number and your email. You can put it in the chat. You can put it in the Q&A. Doesn't matter. Just give us that. We will text you today, like now, and then we will set up a call when you're ready to do the call with us. Listen, that's how we operate. We're here to walk the walk with you, not just talk the talk. Okay? Now that we're through that, let's keep going on to this. When I first started doing this, I didn't have a lot of money. I just didn't, okay? I was this guy, but I only had a couple bucks that I could put into the policy. I just didn't have a ton of money, but I had a lot of debt. So first thing I did is I worked with the mapping team, which is what that I team, was called back then. And that's that walk the walk with you. And they designed a plan to pay off my debt. And I started doing that. And it didn't cost me any more money. I was saving the money in the policy, and then I was deploying it quarterly to pay off the debts. I was taking the difference that I saved from paying the debts off and recapturing that back over the circle. I did what I was taught to do, and they helped me do it in the mapping team. Okay. As I started getting further and further, I'll never forget the day. It's literally seared in my mind. And if Shauna's on here, she could kind of vouch for this. So thank you, William. The team will send you a text and get on a call with you. Shauna, who is our COO, she runs shit around here. Okay. Shauna comes into my office, and in her hand, she had what looked to be a check. Okay. And this is on a Friday. So she comes in with this check, but her face was flush. It was almost like pale, like she'd seen a ghost. And I look up from my desk and I'm looking at her and I'm just like, is everything okay? And she said, no. And I'm like, oh no. Like, what's happening? What's going on? And she said, should I be worried? And she shows me her paycheck. And I'm like, I grab it. I'm looking at it. I'm like, no, looks legit. Doesn't look counterfeit. Kind of looking for that little strip in it. I think this is a real check. I don't think anyone's, just kidding. But I'm looking at it and I'm like, yeah, I mean, what's wrong? And she says, I can't cash this. And I look at her, I'm like, what do you mean you can't cash? Why? Like, is the bank closed? And she then tells me, because she had access to the bank accounts, that she went on the bank's, went in the account and there wasn't enough money to clear her check. Which she said that to me, and she said, should I be looking for another job? Now just put yourselves in that situation. Shauna is a key employee. Like, Shauna is a key person in our operations. She's walking in with her paycheck with concern that she can't cash her check because she just looked at our business bank account and there's not enough money to clear her check. Oh no. So what do you do? How do you overcome that? At first, I didn't have the answer. Sat down, I'm thinking, and it came to me like that. And instantly I'm like, I walk over to Shauna's office, who was right next to mine. And I said, hey, give me till Monday. I said, Monday, you can cash your check. I immediately logged into my account of my policy. I structured a loan, and I took a loan for way more money than what her check was, just so you know. I can't remember how much it was, $5,000 or something like that. I just took a loan just to pad the account, just in case we had any other situations. There was just going to be money in there. I wanted Shauna to look at the account and see a big number. So I don't remember what it was. Might have even been 10 grand. But I did a loan from my policy. Now, luckily, I had the money in my policy. But that was because I was using the infinite banking concept, paying all these debts off. I was starting to build this sucker up. It took me no time at all. I literally went online. I clicked loan, 10 grand. Now what I did is I went and I grabbed a piece of paper and I wrote out a note, a promissory note from Chris Naugle's policy number, blah, blah, blah. $10,000 loan made to Money School at a interest rate of 6%, because I had to charge myself interest because I'm not going to not make money on it. So if the policy back then was charging me 4%, and I know that's hard to comprehend, but back then the policies actually, I think it was 4, maybe it was 5, whatever. I think it was 4%. Craig, do you remember a day where the interest rate was 4%? See, there you go. Sean is saying it was 10 grand. I think it was 4% that they charged.
There were definitely companies in the 4s. A lot of mine were in the 5s for.
This was a Mass Mutual policy. I think there were 4.
Yep.
So I owed 4% on the money. So I charged my company 6%. And check with your CPA. We can't give you tax advice, but there's an economic value that you have to do. And it just can't be that you charge yourself an exorbitant amount. 6% was not. So this is kind of a cool story. So I did this. Shauna got her, saw the account, felt better. Her face, kind of came back to the normal color. She cashed her check on Monday and saw this account in there. We never had this issue again. Now, something after that continued to happen. Money School continued to pay me back those interest checks on that $10,000 loan for a long time. I don't even know how long. I sort of just forgot about it, not gonna lie. But the company paid me back way more. I would have to guess way more than what I initially lent, plus interest. But that was because I built my own banking system. It enabled me to do that. One more story, okay? Because that's just one. That's a business use. I mean, some of you maybe can relate to that, but that like saved me right there. Now, there are a lot of business owners. I got to believe there's a lot of business owners that get into that situation all the time that don't have an out. So what they do is they walk into the bank or they go out to someone they know, their tail's between their legs, just imagine that, and they're kind of begging for money. They're desperate for money. And when is the worst time to go ask for money? When you're desperate. It's always the worst time. There was one more scenario, and I want to just keep going with this because I want you to just keep looking at this thing. You notice how I drew it like 10 different ways, and we're going to keep looking at this because it's the same thing over and over again. We just keep layering. We keep expanding how we think about this. You know, when I didn't have money, here's another thing I always did, and I want to be clear about this. During that period of time and up to this next story, I still didn't have a lot of money. Business was still a struggle. Things were not easy for us back then. I just want to preface that. Like, it wasn't like we were rolling in money back then. It was a new business. It was like this, we burned the boats. Like things were just kind of creeping along. But I was reading and watching videos. I was reading stuff that was like way up here. I was reading about trust. I was reading about all this stuff. I was reading Nelson Nash's books about all this stuff that I couldn't do today. I was getting my mind to think about the future and where I would be, but putting myself there today. I was learning things that I could not apply today, or I should say back then, but there were things that I knew I would be able to apply because I was thinking it into reality. Now, the reason I say that is because even if you're not there right now, folks, just because you're not there, just because you can't apply some of the stuff you're going to learn today doesn't mean you won't be able to. If you don't think you will be able to, then, well, guess what will happen? You won't. But if you believe it's possible, it will happen. If you believe you can achieve something, and you never forget that belief, it will happen. So always think the next steps. Always think above where you're at today. And I want to say that because, listen, some of you listen to that story about Sean, and you're like, I don't have a business. That doesn't apply to me. It doesn't apply to you today, but it will in the future. One more story I want to go into, and then we're going to go into more of the creation. Again, here we are. We got the money in the policies. It is compounding no matter whether we use it. We're going to borrow from that money, and we're never going to give interest away again. We're never going to give interest away to the credit cards. We're never going to give interest away to the banks. Again, we are going to keep the interest. Next story. Same office. Me and Shauna. We had one of those big fancy copy machines. You've seen them in offices, right? It slices, it dices, it mixes, it mashes, it prints and copies. And this one has a stapler on it. But anyway, we had leased this piece of equipment from the copy machine salesman, which I'll never forget. Shauna, you remember this. The copy machine salesman would always come into the office, and he always had, listen, I'm not always the best with fashion, but he always just had like this brown tweed suit on. Maybe I'm elaborating this, with a brown, just imagine like the vertical stripes down it. Okay. You know what I'm saying? Like it was just quintessential copy machine salesman. But anyway, he sold us this copy machine, and typical fashion, he didn't sell it to us. He leased it to us. Like copy machines are always leased because they have a shelf life of about 3 years. So we had leased this thing. I can't remember what our lease payment was. We'll call it $161 a month. Okay. So I want you to all envision it over here. We've got this copy machine. I'm just going to draw it because this is just easier for me. And it's kind of what the copy machine looks like. You guys have all seen them, right? It's got buttons, slicers, dicers, staplers, this little tray thing up here. That's our copy machine. Let's just say we leased that sucker for $170 a month. 3 years went by like that. That day that Shauna couldn't cash her check had come and gone. Things were a little bit better. The policies had grown a little bit. I had continued using the infinite banking concept with the single solitary idea. I'm never going to give interest away again. Can you all repeat that with me? I'm never going to give interest away again. I'm never going to give interest away again. I'm going to keep it all. Think about that. Like, when others are fearful, be greedy. I don't want you to think greedy, but you're just not going to give interest away. Put that in the chat right now. Never. Just put never in the chat like Javier did. Never going to give interest away again. You have to start convincing yourself and telling yourself this, okay, that you're never going to give interest away. Thank you, Christopher. Thank you, Avis. Got John. Oh, all right, now you're all on it. See, sometimes it takes a little bit warming up. Never going to give interest away again. Let's go back to the copy machine story. The copy machine salesman comes in 3 years and 1 day later. Same tweed suit coat. Maybe this time it was gray. Maybe he had a red tie on, but same vertical stripes on it. Comes in, sits down, and says, all right, how you guys doing? How's the machine? Oh, me and Shauna look at each other like, yeah, it's great. It slices, it dices, it mixes, it matches. You know, it does all that good stuff. He says, hey, listen, you know, your lease is coming due, and that machine is outdated now. It's going to be really hard in the coming years to get parts, you know, and I'm just listening to this. I'm like, okay, yeah, whatever. All right, blah, blah, blah. He's probably selling us another one. And basically that then comes the pitch. Okay, but I got this new copy machine. This one slices at twice the speed. It dices at twice the speed. It staples more papers than it did before. It shreds, it dices. Anyway, I'm getting a little crazy here. It's a better copy machine. And he says, and here's the best part. Your monthly payment's only going to go up $10. So remember, we were paying $170 before. So now the new slicer and dicer is now going to cost us $180 a month. I look at Sean and I'm like, all right, that's actually a pretty good deal. I'm almost ready to sign. I'm literally pen in hand, ready to sign for this new lease. Like, get that old hunk of junk out of here. Bring in the new slicer dicer. Let's get this sucker going. And I had this epiphany moment. I stood back. I'm like, wait a second, Mr. Sales Copy Machine Salesman. What if we just wanted to buy the new slicer and dicer? Yeah, legitimate question. Looked at Shauna like I was all smart, and I kind of winked at her like, I got a plan, Shauna. And I look at the copy machine person, and it's the craziest thing. I asked him, how much would it be? He didn't know. He'd have to get back to us. He'd never been asked that question before. I swear to God, he'd never been asked if somebody could just buy the damn copy machine. And then his comment was, oh, gosh, I think it's going to be expensive. I'm like, well, just get us a price. He leaves. I sit down with Shauna. I'm like, Shauna, check this out. I'm just doing this math in my head. If we were to buy this machine and we were to just then take a loan from the banking policies, buy the machine with the loan from the policies, make the same payment, this $180 a month payment back to the policy, I think we'd be the one making money here. So the copy machine salesman comes back a couple days later. He says, all right, well, here it is. I told you it was expensive. It was like $8,700. I run the math. I'm like, $8,700. Okay, let's do some math. So 8,700. $181, or sorry, 180 times 12. So here's how I did it. I'm just going to write this out. $180 was the monthly lease times 12. Okay, so we've got $2,160 a month divided into 8,700. How long would it take me to pay that sucker off? Would it be 2.4 years? Am I doing that right?
I'm sorry, I was answering Q&A, so I missed your question.
And I'm doing my math wrong. Okay, so
Okay.
Craig's going to do the math so I can continue talking. I got a $180 a month lease. Okay, times 12 months, that's 2,160. If the machine is, well, here, let's just do it this way. I'm going to do 2,160, and I think the lease, Shauna, I think it was like 5 years. It was a 5-year lease, which would be $10,800. So if we were to lease the machine, we would have paid the copy machine salesman's company $10,800. But because we did this ourselves, we were going to pay ourselves back $10,800. And that's how I did. I structured the loan. We said, all right, we'll take the machine, $8,700. I'm still going to make $180 a month payment back to my policy. So every month, $180 is coming back. So that's $2,180 a year. So remember, the copy machine was $8,700. Every year, we're going to basically pay back $2,180. So Craig, this is where I need your help. Can you do 5% on $8,700? Because if the insurance company is charging us 5%.
$435.
$435. Okay, year one. Year two, now we paid $2,180 down on the $8,700. What is 5% on the balance? And what is the balance?
6,600.
So 6,600, what's 5% on 6,600?
330.
330. Okay, the next year we're going to do it again. 2,180. What do we got?
So now we're down to 4,420.
4,420. What's 5% on 4,420?
221.
221. And then let's just do it. So it'd be what? About that. Do one more. 2,180 off of that.
What was our last number? Four, what was it?
4420 minus 2180. This is easier if I just ask you to do this.
4480 minus, okay, I lost my number. 44 what?
4420 minus 2180. That's okay, because the more
That's
people hear
22,
this.
2240.
2240. And what's interest on 2240?
$112.
So I want you all to focus on this here. Now, and then, so now we had 1 year, 2 year. We paid this thing off in what would that be? 4 years, not 5. Normally the lease would have taken 5 years. So we would pay this loan back in 4 years. We would keep all the money, or I would keep all the money in my policies. But did you see what happened here? First year, if I just did this annually, which is, it's actually better than this because we're paying it down monthly, but 435 the first year I had to give to the insurance company. The second year I had to give 33 or 330 to the insurance company, then 220, then 112, and then nothing. And the machine is bought and paid for. Normally, how we would have done that is we would have given the insurance, or we would have given the copy machine company 2160. Over 5 years, we would have given them $10,800. And what would we have had to show for that $10,800? Another visit from the copy machine salesman who had the same tweed suit on, selling us the next machine for $190 a month in a lease.
I think he'd have a nicer looking suit by then, though, Chris.
Well, he probably would, but you know what? $10,800 would get a nice suit. But you see what happened here? What we did is we just took back control. And the reason I'm telling the story is, you see how this evolution is happening here? These are real stories. We really did this. I mean, Sean is on there. Sorry, I biffed the math a little bit, but we run the math with software, so I don't have to do it like this anymore. I just wanted you to understand, but like, I made all the money. I gave a little bit up to the insurance company, but I kept all the principal. This is the shift. This is where it starts to change. This is where you start creating your own destiny, your own reality, and your own true banking system. So when we go from there and we start creating this, like, you got to see both sides of this, right? We start creating things, and I love this drawing here. We literally are creating a Swiss Army knife in the financial industry. You see, our policy starts to wear many hats. It starts to solve many problems, just like the Swiss Army knife. It does everything. You even got toothpick, right? You get a little seed from, the strawberries you're eating. You just get the toothpick out of the Swiss Army knife. Like, your policy and the infinite banking concept becomes your Swiss Army knife. It starts to do everything. And I want you to see both sides of this. I want you to see how, in that example, we started recycling and recapturing money. Again, see how I keep drawing this the same way? Starts with the policy. The money that you're saving just changes where it goes. We take loans, we put them into deals, we make interest, we recapture the interest, and we repeat the process over and over and over again. That's the whole thing that I'm trying to get out there. But you got to take it step by step. So far, I explained how we paid off debt. This is the general flow of money. So again, I know some of this is repetitive, folks. There are some of you that are like, keep going, Chris. I know this stuff. And then there's some of you who are here for the first time that need to just see it a few times. I know this because I've done this hundreds, if not thousands of times. And I was like this. I needed to see it more than once. There's a 90-minute video that I was told to watch when I first got started. I have probably watched that video 100 times. And some of you on here, I guess, I don't know, tell me, how many of you have watched the 90-minute video, the fundamental 90-minute IBC video? And how many of you have watched it more than once? You just need to see it over and over. You learn something new every single time. So you got the policy, okay? And this is an example. This is my example. I'm just using my examples today, folks, because it's easier for me to talk about things I've actually done. And one of the very first things I remember I did is I had a key bank line of credit. It was 23 grand. This is that same Mass Mutual policy that we used for the loan for the copy machine, the same one I used for the Shauna loan to make sure her checks cleared, okay? This is the same policy. I had a key bank line of credit. And I made this example because me and Andrew one day were sitting there, we're like thinking, what was like one of the first things you did with your policy? This wasn't the first thing, but this is maybe the third or fourth thing. I always hated this line of credit because I felt like the insurance company or the bank was screwing me. I always did. My payment that I was making to the insurance, or to, I keep saying the insurance company, to the bank, key bank, was $289 a month. So back then, I had 23 grand or I had more in my policy. So I took a loan for 23 grand. And listen, remember I said, some of you might not be here yet. Some of you are looking at this, and I get this all the time on my social media stuff. They're like, who just has 23 grand laying around? And I'd look around and I'd be like, I don't know, I didn't. This was because I put money in consistently and persistently into premium deposits. I built it up. I capitalized my banking system. This didn't happen overnight. This happened over a period of years. But it was no different for me because it was money that I was saving already. And then as I made more money, I layered onto the system, which I'm going to show you in a second. I just kept adding policies because my capacity to hold money in my early policies was gone. Like I could only put so much into those first policies, and then I needed more capacity. So I started adding policies. But I had 23 grand. And again, I know this is a long time ago. The loan interest rate back then was 3 to 4%. So I'm just going to keep it where it is. It was 4% with Mass Mutual. So I borrowed 23 grand at 4%. Today, Mass Mutual is at 5.35. Just setting expectations. I'm going back in time. Today, it's 5.35%. But also today, your dividend is 6.6. Back then, it was like 5.7. See, it's relative. Dividend crediting rate comes up. Loan interest rate also comes up. They don't move in parallel, but usually they're pretty close. I took that 23 grand and I paid off that line of credit. I took the $289 a month that I used to pay to KeyBank, same exact dollars and cents, and I put them back into the policy as a loan repayment, recycle and recapturing to pay the loan down, just like you've seen me do like 3 times today. And I just kept doing this until until the loan to the insurance company was paid back. But you see, the reason I wanted to show this is the name of the game in your banking system is not to pay the loan off all the time. Like you're not doing this. My goal here, and let me preface this, my goal with this one is not to take a $23,000 loan, pay off the KeyBank loan, and repay all $23,000 and then find the next opportunity. The goal is anytime you have cash value to be looking for the next opportunity where your money can go to work for you at a rate higher than you can borrow the money from the insurance company. So today, let's say you could borrow from one of the insurance companies at 5%. If you had a debt to pay off that was like a car loan that was 6%, then that makes sense. Your cost of capital is 5, the car loan is 6. See what I'm saying? I said this earlier. How many of you would borrow or would keep your money in the bank at 6 if you could borrow at 5? All of you would. Same idea. If you can make a spread, the word is yes. It's a consideration. So that's the only rule. I never try to pay all my loans back, ever. I'm always trying to redeploy capital. This is probably the only time in my infinite banking journey that I am hoarding cash because I think something's coming. I think there's a big opportunity coming and I want to be liquid. I want to have a bunch of money to take advantage of these opportunities. Now that is not the same case for every one of you. Many of you have, I don't have any debts anymore except for my mortgage, but I'm already working on paying that down in chunks. So I'm just chunking that down with velocity banking. But all of you are in a different stage. I've just been doing this a long time. So I'm at a different stage where now I'm looking for different kind of opportunities, which require patience. I didn't have patience all the way up to this point. When I had money and cash value, I looked at that money like my little marching men, my little green soldiers, my dollars in my cash value aren't working for me as hard as they can if they're sitting in the policy. But you know what? Here's the thing. I want you to think about something. If you had all your money just sitting in a policy, and let's just say your internal rate of return was 4.5%, okay? Just play with me or play with this idea in your head real quick. You're making 4.5% in your money, tax-free, which is probably like making 6+% in a taxed investment. So you're making 4.5%. You've got this nice death benefit protecting your family. Is that a bad thing to just leave the money in the policy sitting there? I mean, how many of you are okay with that? Like right here, Frank said SpaceX IPO is coming. Good opportunity, okay? But isn't making 4.5% internal rate of return a pretty good opportunity too? Like that wouldn't be the worst thing you could ever do, is it? Money's just sitting there. Who cares? It's okay. But now I want to get into the next thing. I want to move over to the next thing. And Craig, this is where we're going to kind of get into this. I broke this down. Shauna had this good idea, and we're going to call this capital stacking. We're going to start talking about the next phase when all your debts are gone, all your financing needs are met. You don't have any copy machines, slicer and dicers that you need to buy out or finance. You don't have any payroll checks that aren't going to clear. You're good. And now you're like, all right, well, now I want my money to go to work for me. So maybe now I want to do some private lending. So I'm looking to do some private lending opportunities. Well, we created this site called privatemoneyclub.com. You can look at any deal. I mean, there's the deals I always like are the slow flip ones, the $30,000 deals, pay 12%. But these ones are pretty good. Mitzi's comes to all the Private Money Club Money Tank events. She does these affordable housing. So $177,000 loan she's looking for, 15% interest. But you know what? Some of you might not have $177,000 to lend Mitzi. So could you chunk that deal down? Could you capital stack that deal? Yeah, you definitely could. So here, this gives all the details, and you can look at deals all day long. You could call Mitzi, you could follow her, you could message her, you build a relationship with her. 15% interest, it's a 6-month term, option to extend for 3 months with interest payments if needed, secured by the real estate. So I would ask, is that first lien? Promissory note, it might even say it. And then look at this. She's even got an exit strategy in there. That's pretty freaking detailed. Anyway, but there you go. So she specializes in affordable housing, mobile homes or double wides or whatever you want to call them, just affordable housing. Craig, stop sharing for just 1 second. I just want to show one more thing, and then we'll get into kind of how the vault can help this. Let's just say you didn't have 177,000, but you wanted to get into a deal. You could always go to other members on PMC. If I wasn't just hoarding cash right now, you could always reach out to me or Craig or someone else, and you could say, hey, listen, I found this really good deal. I was wondering, do you want to come in and do it with me? I've got, you could say, I've got $40,000 in my IBC policy. I can't fully fund this $100,000 deal that I want to do. And then maybe I come in with $30,000 from my self-directed IRA, or my wife comes in with $30,000 from her self-directed. Maybe Craig comes in with $30,000 from his HELOC. You see, we put the deal together. Now we've got 100,000. And the best part is, if the deal's structured properly, if it was, well, actually Mitzi's was 15%, so let's use hers. 15%, we're all making 15%, but none of us had enough money to take down a $100,000 deal. But by doing it together, by stacking it together, you were able to fully fund the deal, or maybe you could have gap funded it. You could have done a short-term lending deal. But here, what you got to do is you got to participate in the deal with 40 grand or whatever your number is. I don't care. This is 10 grand, 20 grand, 30 grand, whatever that number is. You got to partner in the deal with other lenders. Okay. And it wouldn't so much be a partnership. It could be, this is mortgage, you're on the mortgage as a first lien, and you got to learn. But what if someone on here, I'm sure this applies to someone, maybe even Jerry. Jerry might have 40 grand in his IBC policy, which is not enough to do 100 grand. But then Jerry might also have 30,000 in his Horizon Trust account. And Jerry might also have $30,000 available in his HELOC. So by taking these different vehicles, these different pots of money, now Jerry would have the ability to do the full $100,000. See, it's just a different way of looking at it. And all you're doing is you're stacking capital. All right, Craig, now let me turn this over to you, and you can kind of show them a little bit of how we would look at this on Gains Projector.
Yeah, sure. Let me go ahead and share back out. All right, so we're in a system we call the Vault, and all of the math that Chris has been going through today in terms of how he bought his copy machine, if you kind of got lost in the numbers as we were doing the principal reduction and interest cost and trying to figure out how much the policy grew, we've got a system in place now where you can go and figure that stuff out just by using our loan officer, for example. So you can structure your loans, you can put in your interest rates, see what the APR is going to be of that loan. It also has a promissory note generation if you want to be able to lend money out to someone else. And then if there's anyone here with debts, we kind of talked about that as another methodology. We have this whole strategy called Debt Blaster, where you can put your debts in, learn how infinite banking, velocity banking can be really game-changing tools to get you out of debt faster and build wealth. But what we want to focus on with our remaining time is that capital stacking piece. So imagine in your journey, you went through and you had tools such as the infinite banking concept process in place with a specially designed whole life policy. You use that to get out of debt. Now you're out of debt. You have a HELOC, recapitalized. You have a policy funded. Maybe you make a major purchase, so you structure a loan, buy a car, pay it back. But at some point, you might want to get into that stage where, we've been talking about with private money club, any investment like, and understand. Now it's time to do those capital stacking strategies. And so in what we call the gain projector, this is where you can go in and start to model your specific situation. How much do you want to pull out of your policies? Do you want to pull money out of lines of credit? Do you want to pull money out of cash? And so it's really mind-blowing when you start to stitch this all together, because then you can start to say, well, I want to keep this capital out working. I only want to cover my loan interest. Or I want to keep this capital out working, but I want to pay my loans back. So there's all of these different ways of running your money. So really step one is to come down and pick a policy, or maybe you have multiple policies in your family. And so you could come down and say, all right, well, let's grab, these two policies that have cash value in them. And what the system is going to do is say, you have an available amount of, let's say, 69,000. Maybe you only really want to use 50,000 because you want to keep some reserves or you have another project. But let's go ahead and pick 50 from our policies. And then you can come through and say, well, I've got, 15,000 and maybe a line of credit or a HELOC. So we'll grab that one. And then you may have some cash laying around where you don't really know, like, God, I don't know what to do with this 10 grand. If we could get it into our policies, to Joe's earlier point about getting money into these things called paid up additions, those are the things that are going to help our compounding. I might want to take that money and just stick it in my policy first. But let's just say for today's example, we're going to take in $10,000 here. And even though I've got 15 available, I'm just going to grab 10 out of my line of credit. So now we're taking 50 from our policies, 10 from our line of credit, 10 from our cash. So we're going to take that 50, 60, 70,000 and figure out how we want to now invest it. And so step two is really defining how do you want to, deploy this money. And so we were just on the private money club. Let's just jump right back in there. And let's say that we wanted to do, or partnering with someone else, and we're going to take part of this deal down. So Mitzi's offering 15% on this particular deal. So if you wanted to, you could actually structure in, because she's talking about a 6 month investment. So you could put in a start and an end date, what the property name is, the amount you're deploying and the interest, and then if you want to reinvest gains. But in the gain projector, you can specify multiple investments. And I'm not going to go through all that level of detail right now, but we could have investment one, maybe we've got multiple investments going. Or I can come down, just jump over this section, come down to this section 3, where we can just say, you know what, I'm just going to take this 70 grand and I want to model out an investment at, say, 15%. Maybe it's 12%, maybe it's 10, but you put your expected investment gain here. If you had your line of credit or your cash money being deployed out to a different investment, maybe at a different rate, this is where you could change it. But then we have these radio dials here where you could say, you know what, I don't want to pay my loan interest back. Maybe I'm not planning on paying any loan interest at all back. I'm going to keep my money out there working. And when I sell the deal or I get out of the deal, then I'll just put it all back into my line of credit and my policy. That could be one option. Or you might say, you know what, I'm gonna do my best to keep this capital out working. And so I do want to cover the loan interest in my policies, and I want to cover the loan interest in my lines of credit just at a bare minimum, and then the rest of it's going to stay out working. So as you can see, you can kind of model this however you want to see how the numbers are going to pan out for you. So then we can go down to the next stage and we can evaluate the results. Now, many of you may look at this and go, wait a minute, Craig, what are you talking about here? You're showing a negative 15% cumulative return here. You have to remember a lot of the funds are coming from our whole life policy. And we've done teachings like last week we talked about the parable of the bamboo, how it takes time for our policies to get efficient, but then we're going to get to a point where we're going to be getting way more than we ever put in. So what we're seeing here is some of that lag that we have in the specially designed whole life policy. But as we kind of flip through the years, we can start to see, then we get to 8, 17, 26, and on and on and on. So there's different ways we can construct this. We can make the cumulative happen earlier. There's all sorts of ways of designing this out. So here we can see what's the cumulative amount of capital injected into our whole system, and this would be the policies and the cash that we're putting on lines of credit. What's the net benefit? So think about, of all the investment gains we have, the amount of capital we have deployed, the cash value we have in our policy, all of those things are going to be considered our net benefit. And here's the nice thing about it. The policies have a death benefit coming along for the ride. We don't spend a lot of time talking about the death benefit, but what a huge, absolute, valuable benefit to have coming along for the ride because God forbid something happens to me. I'm investing this money, I'm putting it to work. I've got, say 929,000 out there working in my investment by year 7 and I get hit by a bus. Well, my family has about $1.5 million of death benefit remaining to take care of any other obligations or clean up anything I left behind. So there's a lot of ingredients here that bring a lot of benefit to you and your family as you're deploying this money to work. Now there's other graphs if you want to kind of look at what the cumulative return looks like over your cumulative injection, and you can kind of pace that out over, years 1 through 15 and beyond. But the view that I really like is when we get down to where we can show the presentation layer. And what this is, it's a file you can download, run in PowerPoint, run in Google Sheets, and automate the year over year investment strategy. So think of this. We're putting some funds into our policies. We're capitalizing our policies. We may or may not take all of the loan. There's nothing wrong with leaving some there for emergencies, for other opportunities, or maybe we have a major purchase coming up. But now I want to take 50,000 of my available policy funds. You'll see this is our BYOB policy. This is what we designed for our infinite banking system. So we're going to pull 50,000 out of that. It's going to go into a segregated bank account because we need to have our life insurance company linked up with a bank account. That's where the money's going to go initially. And then remember, we were pulling $20,000 out of our line of credit, maybe our HELOC, and we're also taking $10,000. So we're kind of consolidating all of this investment capital into just a separate bank account to get it all staged. Then we go out and talk to someone like Mitzi, say, hey, Mitzi, I've got 70 grand. I know you need, I think it was 170 or so, but is it possible that I could do 70 and you could find someone else to pick up the other piece? She might say yes. All right, well, let's go. You've done all your due diligence. You looked at her financials. You looked at the deal. And so you deploy that 70,000. Now that's going to be making a 15% yearly return. So we're kicking off about 10,500 off of that 70,000 every year. What are we going to do with that 10,500? You can see in the flow, the way I've got it set up right now, we're going to scrape enough of our gains to pay the policy interest and our line of credit interest. The rest of it, that 7,450, that's going to be added into the investment capital along with taking more policy loans. And so we're just going to keep stacking this investment capital and keep it working. So now we've got 19,000 we're generating. So I'm just going to jump down to year 10, flip through all these years. So assuming you keep doing this over and over and over for 10 years, you now have about 1.2 million in investment capital, generating about 182,000 in investment gains every year. Just to cover your loan interest, it's 36,000 for the policy. Let's call it 550 for the HELOC. And we now have 145,000 that we're just going to keep reinvesting. We may say, you know what? I don't want to do this anymore. I don't want to invest anymore. I'm now in retirement. Maybe I keep this whole ball of wax going where I just use, instead of reinvesting that 145, this becomes supplemental retirement income. So you can now say, well, at year 10, let's just stop doing what we've been doing and kind of, look at it from that perspective. So anyway, there's a lot of really cool things you can do with modeling because we want to model and see, does this work for what I'm trying to accomplish? And let's just go ahead and shut the loan interest off on both of those. And I just want to show you what the system does. So we'll jump back down to our gain projector, go back to year 1. So now we're not that I'm advising to say to do this or not to do this. I'd only skip the loan interest if we have some strategy to fill that back in, fill that loan back in at some other point. But what I'm doing right now is I'm taking the gains from that 70,000, that 10,500. It's not being scraped off to pay interest at all. It's just going to go right back into the investment. So we're keeping the maximum amount of capital working out there. And so I'm going to just jump down to year 10 and let's see what that looks like. So if we did that for 10 years, we're going to create a loan balance inside of the policy. But what's cool is we're now generating about 216 every year versus I think the 145. But we do have a loan that's been building in the policy. So we want to have some plan to either pay some of that loan interest so it doesn't keep compounding on us over time. But you can see there's a lot of different ways to stitch this together and bring together, as Chris was talking about, capital stacking, where we're taking some from HELOC, some from policies, from cash, whatever it might be, and just putting that money to work and seeing what would that look like if I did a private lending deal, if I invested in my business, or I mean, I've even talked to people that have vending machines or ATM machines. It's just incredibly crazy what you can do with these opportunities and anything like and understand. So, Chris, anything you want to add to that?
No, I think the only thing, that I always preface when you're looking at deals like this or, investments or private lending deals is to be very, you know, considerate of the risks, with the
Mhm.
lending or the deal you're lending on. And, one of the things that I always do is you want to make sure you understand underwriting. And if you don't, find somebody that does, find somebody that can help you look at the deals, give you financial advice on the deals, look at your current situation, make sure it makes sense. Like we're just showing you flow and numbers, but there's another side, making sure that there's collateral, sufficient collateral on the deal. And if all that stuff just sounds foreign, which it probably does to a lot of people, because they're like, I don't know anything about how to underwrite a deal. Not a problem at all. I mean, there are people that just underwrite the deals for you. There are people that can give you the advice and literally go soup to nuts, top to bottom, and underwrite the deals. If anyone had interest in that, I mean, Private Money Club, there's underwriters in there, but also PMC Wealth, the advisors there. That's what their job is. That's what they do. They give you financial advice on any deal and underwrite your deals. So I just always want to make sure that, we're talking about the risks, the safety, and the professionalism on the deals that you're getting into. It all looks great when you're just looking at an interest rate, when you're scanning through Private Money Club, looking at the deals, but make sure you're underwriting the deal, make sure you're protecting your money and looking at the risks in the deal and pairing that to what your risk reward profile looks like. That's all.
Yeah, and Chris, if we have another 5 minutes or so, I'm happy to share with kind of the basis of how I do this because I don't just keep
Please.
everything just maximum out there. We have time to go over that. The first thing I do that helps me kind of manage this whole process is, we've got money flying everywhere. And, if you're like me, you've got personal accounts, personal credit cards, business credit cards. And I'm kind of a control freak when it comes to the money situation, so I like to do my own bookkeeping, and I know everyone's in a different place, so if you're running multiple businesses, it may not be doable. But what I do is I link all of my accounts, my credit cards, my bank accounts, my first lien HELOC, all of those things, and I use Quicken. And the reason I use Quicken is I've just been using it for so long and I've built systems around it. But every day I download my transactions, and so I can see what's coming in from private lending, what are my expenses, what are my incomes, and all those things. And then I export that into kind of a system that allows me to kind of look at what I call a living financial statement, balance sheets, my capital at risk. So there's different things that I measure: capital at risk, how much capital is clear, how much capital is out working. And kind of how that works is I have what I call my liquidity infrastructure. That's my multiple policies, my all-in-one, which is a first lien HELOC. And I just kind of look at that as my warehouse of money or where I can go get money if I need it for an opportunity or for major purchases or whatever it might be. But this system for me, what it does, whether I'm borrowing from my policies or my home, my HELOC, well, I'm still going to get that growth, especially in the policies. I have that uninterrupted compounding. I have long-term appreciation in my policies in my home. I have opportunity funds. I can self-finance. I can pull money out for emergency funds. But I do this in a safe way. And how I'm doing this, let me just make this larger.
That's way better.
I
I was
have,
really squinting looking at it. And I don't know if
yeah, sorry
I'm
about
in
that.
trouble.
Sometimes I just forget to hit that easy button, but not that I'm saying this is how everyone else should do it, but this is how I've done it for years and it's worked out well. As I maintain liquidity, so I'm never fully leveraged. So I always have money for opportunities that might come up. I have money for emergency funds, financing major purchases. But what I'm doing is I'm kind of balancing out what I call my deployment of capital. And so I always want to know how much capital do I have at risk? Chris was just saying it's very important to look at the deals, do all the underwriting. We have resources with our PMC wealth team that can help you do that underwriting. But the way I roll is I'm only going to deploy if I'm under a certain amount of capital risk. So what is capital risk for me? This is what it means. If I take 100,000 I deployed into a deal, day one, I have $100,000 at risk, right? So let's just say that deal went south. I could lose that 100,000. Well, we're going to have to get over that to get this whole system started. But as your system matures and you have multiple things going and you have a portfolio going, I might say, you know what, I'm okay being 50% at risk or maybe 70% at risk. You'll come up with your number, I have my number. But what that means is over time, if I've received $50,000 in interest payments back, that means I put 100 out, I have 50 back, I still have 50,000 out there that's at risk. So that means to me, I have 50% capital at risk. The other things I look at is how much capital do I have at rest? That's kind of my liquidity. And so I'm always measuring these things to know when I'm going to do another deal. But here's what I like to share and think of, let's say you take $100,000 out of, could be HELOCs, could be that capital stacking we just talked about, could be policies, could be HELOCs, could be your self-directed IRA. You take that 100,000, you put it to work at 12%. Well, that's going to generate $1,000 a month. And if that was all that you were using to repay that 100,000, let's say for me, it would take about 8.3 years to pay that 100,000 back. And so through that cycle, I'd be looking at when do I have a certain capital at risk number that was reduced so I can maybe deploy more. But like I said, all of that's up to everybody individually. But if you're using velocity banking and infinite banking, this 8.3 years is going to go a lot faster because I'm using my income, paying out my expenses out of my HELOC. But let's just say the first 100,000, it takes me 8.3 years to pay that off. Let's go to the next 100,000. So 8 years later, I say, okay, I've paid everything back. Now I'm going to deploy another 100,000. So now I have 200,000. 100,000 of that is clear of loans. The new 100,000 is not. But now I have 200,000 going back. I have 200,000 at work coming back at $2,000 a month to whittle that $100,000 down. So now it takes me 4.16 years to pay that 100 back. So now I do, and let's say at some point I have 500,000 at work and 100,000 of it's not clear. Do you see how fast that money out there working is clearing out this new money? Now that I have 500,000 out there working, it's generating 5,000 a month. I'm clearing that 100,000 out at 1.6. So my whole strategy through what I've been doing for years is keep deploying chunks of money, get some of it paid back, then deploy a chunk of money, get it paid back. And so you can see the bigger the chunk you have out there working, it's just going to keep clearing that new money faster and faster. So if you can put 100,000 out there, have it, get paid back in a year or even 6 months, that's pretty cool. But whether that number is 500,000 for you or 50,000 for you or 5,000 for you, the system works. It's just that I always want to do this in a safe way. So I'm never, going full bore, taking everything out that I have and throwing it in an investment and hoping it comes back. So it's kind of like a stepping stone of just keep throwing some out there, get it paid back. Now throw some more, get it paid back. But anyway, if there's any questions on that, happy to address it, but that's how I've done it. And the cool thing is with this gain projector, you can kind of model that out for yourself to see where are some of those breakpoints of how much do you want to put out there? How much do you want to have coming back into your system? How much do you want to keep out there working?
I think that was great. And listen, one of the things that I kind of wanted to accomplish and the team wanted to accomplish today is just kind of walk you start to finish through the infinite banking concept. The vault was kind of like the GPS for the whole thing. A lot of people when they look at the infinite banking concepts, I think one thing that sometimes stops people from actually doing something is they look at it and they say, this is too complicated, or this is too much for me to learn. But the vault eliminates all of that. Literally, like even if some of you are like, I'm not good at software, great. Well, we have done for you services where we'll do everything for you. You don't have to do anything. You just tell us your wishes, what your goals are, what you want to do. We can even kind of help guide you on a lot of that. That's what our mentors do every single day, solve people's problems. And we're more than happy to walk through that and show you how to do that. Again, I said it earlier, the one thing with any of our companies, you'll never talk to a computer. It's just not part of it. And I'm taking lots of measures and spending lots of money to make sure that no matter what it is any of you ever need, you have access to somebody with the dial of a number. And getting back to literally, I don't mean to say this, but getting back to like the way things were back in the 80s, the way things were in the 90s. How many of you missed those times? We didn't have cell phones back then, but when you picked the phone up and you called any company, guess what you got? Someone who answered the phone. I can't tell you how excited I am when I call a company and I click whatever button it is for the department I want to go to, and a human being answers. Like, I feel like I struck gold. I feel like I literally hit the jackpot. Like, that feeling is what I want all of you to feel when dealing with my companies, when dealing with our companies. When you want something, you have someone to call. And I've said that numerous times. All you need to do is, and I know a bunch of you already have, just like Jay just did, just give us your contact, give us your number and your email. We're not going to bother you. We're not going to, constantly blow you up. We're just going to text you, and we're just going to say, hey, when would you like to talk? And I can make one other promise too. When you do a call with us, we're not there to sell you something. We're there to solve a problem for you. If you want to then do business with us, if you want us to help structure your policy, or you want to buy the vault, great. We'll help you get that done. But our job, all of our jobs, are simply to solve your problems. As Ritz-Carlton would say, we are ladies and gentlemen serving ladies and gentlemen. And that is the experience you will have with our companies. And it is going to get better every week, every month, and every year from here on out. AI will be part of everything, but always on the back end. AI will do the busy work the humans shouldn't have to do, so the humans can focus on the humans, and the ladies and gentlemen serving ladies and gentlemen. So again, I hope you all have enjoyed this wealth webinar. I hope you've really kind of picked some things up. And one thing I want to preface is, and I know this firsthand, I know when you look at the infinite banking concepts and you look at all the things, the universe of investments, it's daunting. There's so many things you can put your money into. Oh my God, you can do real estate deals, you can do private lending deals, you can do notes, you can do mobile homes, you can do stocks, you can do bonds and options and everything. But let's just quiet the noise down. The first and foremost thing you need to start with is take back the money you're giving away. Build wealth through your debts and expenses. It starts there, and that is the only place you should start. If you have debts, car loans, if you have credit cards, if you have any debts out there, we take that money back first. The return on that is significantly better than the return you're going to get anywhere else, and there's no risk. And right now is not the time to take risk. Warren Buffett isn't sitting on whatever it is now today, $400 billion in cash, because he loves cash. He doesn't like cash, but he knows there's something coming. And I'm telling you, there's something coming. And that something needs to be an opportunity, not a tragedy. Okay. So you need to look at it through the right lenses, and you need to pull the reins back, start being patient, look at deals very carefully. Analyze them. Get the proper people in your corner. I don't care who those people are. Maybe it's Noah in the accelerator coaching program. Maybe it's Stefan and Brandon in PMC Wealth. It doesn't matter who it is. Get the people that can guide you into whatever it is you're trying to do. Our mentors, Craig's team at the Advanced Services, that's what we're here for. To guide you, to walk step by step with you, to hold your hand if that's what's needed. That's what we do day in and day out. And I just need you to know that. I need you to hear that from me, because, sometimes, sitting at the top, like I look down and I'm like, these are the things we need to improve on. And these are the things we are going to improve on. We're going to get better and better at it, but we're going to get better together. So with that being said, folks, thank you for joining us. Again, if you want to set up a call with us, give us your number here. We're taking them down. We'll text you. Thanks, Avis. And let's just have a good conversation. Let's see what we can do to help you. and let's see what we can do to guide you through. Very last thing, in that universe of all the investments, the one thing I will tell you is most people, not all, most people will not need to ever really step foot into that world, because your own financing needs in your life, your cars, your kids' college, your mortgage, your financing needs in your own life. For a lot of you, once you start implementing the infinite banking concept, you will find that that will be sufficient. Just add up all the bills, all the checks you write to all the debts you have. Imagine if you wrote those checks back to yourself. Take a piece of paper, go on there and add them all up. If you're a business owner, holy shit, excuse my language, but go through and add up all the checks you write to all the loans that you took out for things in business. What if all that money came back to you every month? Would that change your life? Would that make your life better? Would you be in a better financial place? The answer is almost always yes, 100%. So start there. Let us help you. And with that being said, thanks for joining us for this wealth webinar. And we'll see you this afternoon for every week. Ask Me Anything happy hour. So that starts at 4:30. All you need to do is be part of the YouTube channel, which is at the Chris Naugle, and click that little bell, smash the bell. Check out my videos on YouTube where I practice my Kung Fu, my Bruce Lee. Anyway, going too deep into that. But William, everybody else that's on here, thanks. We'll see you next time.